Hey, welcome back to MarketSnap. This week, we are breaking down the biggest stock moves from the trading period ending June 5th, 2026. We'll look at several names that saw sharp swings and ask whether the market got it right, overreacted, or simply changed the price it was willing to pay. Let's start with the broad picture. This was not a clean, straight-line sell-off. The first part of the week had plenty of strength, but the final two sessions changed the tone quickly. By the end of the 5-day period, the S&P 500 was down about 2.6%, while the Nasdaq fell about 4.6%. That tells you where the pressure was concentrated. The broader market was weak, but the real damage was in growth, tech, and the names where expectations had already been running hot. The VIX, the market's fear gauge, also jumped sharply into the sell-off. That does not mean full panic, but it does tell us investors became much more cautious by the end of the week. In our tracked universe, the sector picture also showed pressure in growth and cyclical areas. Basic materials, technology, healthcare, consumer cyclical, and industrials were among the weaker groups. Defensive, financial, and commodity-linked areas held up better, but even there, strength was limited. So this was not just one isolated pocket of weakness. It was a market where investors were reassessing risk. The macro backdrop explains part of it. Stronger jobs data pushed rate fears back into the conversation. Treasury yields moved higher, and that matters because higher rates put pressure on long-duration assets, especially technology, AI, and high-growth names where a lot of the valuation depends on future earnings. The AI and semiconductor story was mixed too. Some stocks still had huge 5-day gains, but the final day showed how fragile those moves can be when sentiment turns. A stock can be up sharply for the week and still get hit hard on the last session. That is exactly the kind of market where you need to separate momentum from fundamentals. For long-term investors, the question is not simply what went up or what went down. The better question is this: did the business actually change, or did the market just change the price it was willing to pay for the same story? That is the lens for today's video. We're going to walk through several stocks that moved sharply this week, check the catalyst, compare the move with valuation, and ask whether the reaction made sense. Starting with stock number one. Stock number one, Marvell Technology Inc., ticker MRVL. Marvell was one of the biggest movers of the week, up about 32% over the past 5 days. But this is where the story gets interesting. The stock was also down almost 17% on the final day of the period. So this was not a calm rally. It was a huge move higher, followed by a sharp reversal. That matters because it tells us the market was excited about the AI and data center story, but also very quick to take profits once tech sentiment weakened. The move was tied to AI and data center optimism, with investors focusing on Marvell's role in custom silicon and connectivity for the next phase of AI infrastructure. That story is real. But the size of the move raises the bigger question. Did the stock price move faster than the fundamentals? According to the MarketSnap model, the stock now trades at roughly $263 per share. Our fair value estimate of just $89. That implies a downside of 65%, and the base 5-year compound annual growth rate is negative 19%. So the model is not saying Marvell is a bad company. It is saying the stock price may have moved much faster than the long-term valuation support. One important note before we go ahead. We always encourage you to run your own valuations on our fair value calculator. Even the same person can come back to the same stock at a different time and get very different numbers, simply by changing assumptions around growth, margins, discount rates, terminal multiples, or free cash flow. So treat these models as a research tool, not a final answer. Was the move deserved? Partly. The AI and data center excitement is real, and Marvell clearly has a story the market wants to believe in. But when a stock can rise more than 30% over 5 days and then fall almost 17% in one session, that tells you the move is fragile. The weekly gain was impressive, but the final day reversal shows how much expectation is already built into the price. What to watch next? First, watch whether Marvell can hold these gains after the final day sell-off. Second, watch future guidance around AI-related revenue. If the company can show the growth is real and durable, the story gets stronger. If guidance disappoints, the valuation risk becomes hard to ignore. Stock number 2, Planet Labs PBC, ticker PL. Planet Labs took a major hit this week, falling more than 34%. That extends a one-month decline of about 13%, so the selling pressure has been building for a while. The catalyst was earnings week, ending June 5th, 2026. The company reported results, but the market clearly did not like what it saw. Planet Labs still has an interesting long-term story in satellite imagery and geospatial data, but the numbers did not reassure investors who were already nervous about growth and profitability. According to the MarketSnap model, the stock is currently trading around $32. Our fair value estimate is about $14. That implies an upside of negative 55%, meaning the stock still appears stretched even after the sell-off. The base 5-year compound annual growth rate is negative, which suggests the model does not see enough long-term valuation support at current levels. Did the market get this one right? Largely, yes. The stock was priced for a stronger growth story, and the latest update did not do enough to support that expectation. The business story may still be intact, but the stock price had been asking for more than the fundamentals were ready to deliver. What to watch next? First, watch customer contract announcements. Planet Labs needs to show that demand is turning into durable, recurring revenue. Second, watch any updates on cost discipline and the path to profitability, because the market is becoming less patient with growth stories that still burn cash. Stock number 3, Sweetgreen Incorporated, ticker SG. Sweetgreen took a sharp hit this week, dropping more than 27%. That is a brutal move for a single week, especially because the stock had been showing some strength before the sell-off. So what caused the panic? The move appears tied to broad pressure across fast casual and consumer-facing growth names. Sweetgreen fell hard as investors questioned whether the company's growth story is slowing and whether consumer pressure is starting to show up more clearly. The stock now trades around $7.42 per share. According to the MarketSnap model, our fair value estimate stands at about $12.47, implying an upside of roughly 68%. On a 5-year basis, the base compound annual growth rate is near 10.9%. So this one is different from the first two. The stock fell hard, but the model does not show it as wildly overvalued. In fact, the fair value estimate is above the current price. Was the sell-off deserved? Partly. The move reflects real concern about near-term demand, margins, and how much growth investors should still expect from Sweetgreen. But a 27% weekly drop feels severe if the long-term story has not actually broken. The model suggests the panic may be somewhat overdone, but the expected return is still modest, so this is not a screaming bargain either. What to watch next? Same-store sales will be key in the next earnings report. If traffic and order growth stabilize, the sell-off may look excessive. If demand keeps slowing, the market may be right to reset expectations. Stock number 4, CBOE Global Markets, ticker CBOE. CBOE Global Markets, the exchange operator, dropped about 18% this week. Over the past month, shares are also down around 18%, so this looks like a sustained sell-off rather than a one-day panic. The catalyst appears to be broad pressure across exchange and market infrastructure names. CBOE slightly underperformed its group, but the bigger story is sector-wide pressure. Investors appear to be rotating out of fee-sensitive financial market infrastructure names amid uncertainty around volumes, regulation, and the sustainability of trading activity. There was no obvious company-specific earnings miss or major guidance cut driving the move. This looks more like macro and sentiment pressure than a single broken business event. Our MarketSnap model currently shows CBOE trading near $282, with a fair value estimate around $316. That implies roughly 12% upside from here. The base case 5-year compound annual growth rate sits at about 1.7%, which reflects a mature, slow-growth business. Was the move deserved? Partially. An 18% weekly drop feels large for a business that mostly moved with its sector, but the low growth rate matters. Investors are paying for stability, not rapid expansion. So the sell-off may have overshot the fundamentals, but it is not an obvious high-growth opportunity either. What to watch next? Keep an eye on options volume, volatility levels, and any regulatory updates around market structure. CBOE's business is tied closely to market activity, so if volatility stays elevated, that could support revenue. But if trading activity slows or regulation becomes a bigger concern, the pressure may continue. Stock number 5, Strategy Inc., ticker MSTR. Strategy Inc. took a major hit this week, dropping nearly 20%. That extends a one-month slide of almost 36%, making it one of the bigger losers in this recap. This one needs to be understood through the lens of Bitcoin and risk appetite. Strategy is not just a normal software company anymore. The stock is heavily tied to Bitcoin sentiment, leverage, and the market's willingness to pay a premium for its Bitcoin exposure. So what caused the move? The sell-off appears tied to risk-off pressure, crypto-related weakness, and concerns that investors are less willing to pay aggressive premiums in a market where rates are moving higher and speculative appetite is fading. Here's what the MarketSnap model shows right now. The stock is trading around $120, while our fair value estimate sits around $124. That implies a very modest upside of about 3%. The 5-year base compound annual growth rate sits at just over 0.5%. So the stock is roughly fairly valued by the numbers. Was the move deserved? It feels excessive if you only look at the model upside, but this is not a normal valuation case. With MSTR, the market is also pricing Bitcoin exposure, volatility, leverage, and sentiment. A 20% weekly drop can happen quickly when risk appetite disappears, so I would frame this as panic with a reason. The model sees upside, but the volatility is part of the story, not a temporary bug. What to watch next? Watch Bitcoin first. If Bitcoin stabilizes, MSTR could recover with it. If crypto weakness continues, the stock may remain under pressure even if the model shows upside. Also, watch company updates around capital structure, Bitcoin purchases, or any changes in strategy, because those can move the stock quickly. Let's recap the week. Marvell Technology rose sharply over the 5-day period, but the final day reversal showed how fragile the move had become. Planet Labs dropped 34%, and the market appears to be questioning whether the growth story is moving fast enough. Sweetgreen fell 27%, but the model suggests the sell-off may have been somewhat overdone. CBOE Global Markets lost 18%, mostly on sector pressure, not a clear company-specific breakdown. And Strategy Inc. dropped almost 20%, with Bitcoin and risk appetite still driving the story. The common thread this week is that big moves do not always mean big fundamental changes. Sometimes the market is reacting to real new information, sometimes it is repricing expectations, and sometimes it is simply taking profits after a move that went too far, too fast. None of this is financial advice. Use these names as a watch list for your own research. Check the description for links to the MarketSnap screener and intrinsic value tools. Thanks for watching.